We welcome you in our Right FinTalk Free Live webinar. So first, let me introduce Mr. Anil Rego sir. So Anil Rego sir is founder and CEO of Right Horizons and fund manager of Right Horizons PMS also. He needs no introduction as he is well-known expert in personal finance and markets and is known to many of you. He regularly contributes in columns, articles, and publications and appears on various TV shows on ET Now, CNBC, etc. As a panel expert on markets and mutual fund. He gives guest lecture on wealth management at premier business schools. He is the author of book Honey, I Lost All Our Money. His aim is to assist people in achieving their financial goals, a mission that is dear to his heart and one that he accomplished at a young age. I hand over the session to Mr. Anil Rego sir.
Yeah, thank you, Sanjay, and welcome to this webinar. This time we took a topic on global investing options. I think before I started, I just wanted to take your inputs as to, is there something that you would like to know, or what are your expectations, so that accordingly, I can capture some of them. If you could use the chat window, I think that will be useful. Yeah, so I think we have a lot of questions. Okay. Yes, so let me try and take through, how we go about it. Typically, I think most of us are aware of investment options which are, through Indian mutual funds, right? Some of them offer you investment in, say, S&P 500 or NASDAQ, and, there are ETFs. There are also funds which, allow you to invest globally. Some of these funds are also commodity-based funds, like, let's say, the gold mining funds of DSP are there. So that is something that we have normally, looked at investing. This time I thought, let me cover something which is a little wider and outside. Okay, and so what are the options of sort of directly investing globally and investing beyond mutual fund itself? Okay, and this became a lot more important thanks to the RBI cap being achieved. Okay, so and because of that cap today, global funds are not able to invest into companies outside India or funds outside India. And so this is a sudden disruption that has happened, even more necessitating something like, how do you go and invest directly overseas within other regulations, not necessarily on the Indian side. And there are a lot more options and opportunities as well. Okay. So I thought before I go any further, a quick poll to understand, how, all of us are investing. Okay. So I'll request Sanjay to just run the poll. So which is basically, what percentage of your portfolio is in global investment options? Yes, we'll just give you a few more seconds. Yeah, I think broadly, we have achieved a stable result. Okay, so what's interesting, and it's surprising me as well, almost like 69% are nil. Okay, which means that 69% of us have not invested in global options. I think which makes it probably a very important thing for you to look at right now, and definitely worth considering. And I think the idea of having this webinar on this topic probably, hopefully it will be helpful and educative to all of you. The 22% are saying up to 10%, and about 3% 10 to 25, and about 25 is about 6%. Okay, so I'm assuming some of these will be NRIs. Okay, and also possibly, if you have ADR or you're been resident overseas, in the recent past. Yeah, thank you. And we'll close the poll. So first of all, why global investing options in the first place? Okay, so if we look at it, I think some of these are well known to us. It's about diversification. Okay, because if you only invest in one country versus sort of investing globally, right? You definitely have diversification. And let me give you an example. The last decade, the US did extremely well, right? And if some of us had an exposure to either US funds or US stocks, they would have really, gone through the roof in the last decade, even up to probably the last year or two, right? So, and on the other hand, the last decade was a very poor decade for India, right? So in a situation like this, it really makes sense for us to have global diversification, and now many of us think that yes, you can only invest in US, but a lot of other options as well. You may look at other emerging markets. You may look at China. Somebody may, choose to look at even Europe at some point of time. Okay, so there are a lot of investment options which are available. The second diversification comes also maybe across asset classes. In fact, the second point also covers that a little bit when we are saying wider range of investment options. Now, only recently we have silver ETF. Okay, and that silver ETF basically has been just young, but globally you can even invest in, for example, platinum. You can invest in copper, which you may only be able to invest through FNO, etc. In India and the commodity market, right? So you may have much better ETF type of options like mutual funds. Okay, global ETFs are available which invest in a whole lot of commodities, in a whole lot of other spaces. It may even be high tech companies, very disruptive companies which were not available in India or through India. You have certain options out there. And I thought this time what I'll do, I'll make it give a lot more examples to take you through what are the type of investment options. So we will go through the whole list of them, and we've tried to keep a sample across various categories for you to look at diversifying. The other is when you have your children, children's education, obviously the education which you're planning for, okay, over a period of time. Then it's important to have some of these in global currencies, so that if the rupee continues to depreciate, you are covered a little bit from, say, the rupee depreciation. And also if at some point of time you have any forex curves, etc., which of course the good part is in recent times we don't have those issues, but in an extreme situation, overseas assets also help. The other is about currency diversification. I just spoke of currency as well, and you find that the dollar and rupee sort of move at different points of time, and currency diversification is definitely something where one sort of looks at. Again, I would like to emphasize that you may have dollar, you may also have other currencies. You may choose. For example, you may choose certain markets which are commodity based and sort of likely to do better. You may go and put some money into those currencies. And the last is also political risk. At points of time, clients have come to me and said, I'm uncomfortable investing because of this political risk in India. And so in such cases, it also makes sense for you to diversify globally. So this is a bit of an overview. Sorry, it's a slightly crowded slide, but it's just to try and give you a snapshot and sense of seeing how some of these things work. Okay, both risk as well as return. That's why we captured how each of these work. I'll first explain some of the headers here. Obviously, I think the 1 year, 3 year, 5 year, etc. don't need any explanation out there. Okay, what on the other hand, volatility is basically an index to say how volatile a particular commodity or a stock is. So, for example, you will find that stocks like Tesla, Amazon, which are sort of very well known, are extremely volatile in comparison to some of the funds, and that is very, very obvious sort of out here. So volatility is one. The second measure is on maximum drawdown. So what do we mean by maximum drawdown? Maximum drawdown is, from the peak, what is the largest fall? Okay. So for example, if we have, a particular stock which has gone to, $100, and then it falls to 60 from the peak in that one fall, then you call that maximum drawdown is 40%. Okay, so that's how it is. If on the other hand goes down to 40, then the maximum drawdown is 60%. So what is interesting out here is, having multiple stuff on one slide, right? You can see that how volatile and how large some of the falls have been, which means if you invested in let's say a gold miners ETF, you could have seen up to 80% down. Okay, so that's from the peak. So that is something that we need to keep in mind. And some of the equity-like options, right, including, let's say, if I look at what is the Sensex maximum drawdown, in my view, also will be somewhere around, the 60s. Okay, so that's how, let's say, the whole Indian index itself is, right? So one concept that if you look at here is some of the funds that we have a reasonably low drawdown, and that gives us diversification. So let me go segment by segment since I've explained the headers. The first is, commodities, and while we have, let's say, a gold miners ETF in India as well, okay, you also have a silver ETF now, okay, but you may not have some of the others. Okay, so you have a broader commodity ETF which is available, and to that extent, it may also be less volatile. Or if you find that the non-precious metal stocks doing well, which is what has happened actually in recent times. Gold has not done as well, but most of the other commodities have really spiked up, and you can see that a 1-year return of the commodity ETF that we have of Invesco had delivered 61.87%, right? And a 3-year return almost like 20% per annum compounded for 3 years. So some of these, if we are able to capture cycles, it can work complementary. And in fact, we believe that this is a good cycle for commodities. This has been our view, almost like last 3-4 years, saying that we think commodities will come back in this decade and do very strongly. So one believes that it's a slightly longer tenure of a commodity rally. And from that standpoint, having a commodity index, which includes stuff like right from all the metals like steel, copper, aluminium, etc. Some of them may also have, fuel out there. So oil may be something also which is there. So commodity index is something which can be complementary, and like I said, some of these options are not available in India. Okay. The second set is a set of funds, and which is what I think to sort of look at. I think some of these have done reasonably well. Okay, so if you see like funds like G2, right, the first fund that we have among the equity funds. Okay, it's done extremely consistent. Okay, and a 5-year 15% type of return. Of course, in the last 1 year, it had gone a little slow, possibly because of a little bit of the global volatility as well. Okay, but the fund looks to also hedge, and which means that and also take positions, both positive and negative. So which means technically they can, also make money when markets fall. Okay, of course, the question is whether, it's difficult to get it right all the time. But what's the best figure out of this is if you see the maximum drawdown is only 5.7%, which means the worst fall is less than 6% out there. So that is something which you have some of these funds. Since we're covering these in detail later, I am not going to spend more time on it right now. Okay, so we also have then ETFs, where we've tried to capture a combination. You can have either a sectoral ETF, for example, a Vanguard Healthcare ETF is something that is there if we are bullish on a sector, and globally, not just India. Similarly, if you have are bullish on a particular market, so whether it is a developed market like the US, and you say, I want to look at S&P 500, right? And so you can look at that, okay? And you can see it's not done too badly, 13% compounded returns over, almost like 5 years. Okay, so those are that shows how well, let's say, the US market did in the whole, last decade as well. And you may also look at investing in emerging markets like Vietnam. Okay, sometime back it did really well. Okay, the view probably it's likely to pick up because I think Vietnam is expected to, benefit from the China plus one. Some of the manufacturing going on pretty well, but I guess it got hit a little bit because of its exposure, to Chinese companies right now. The other is you may look at, I think some questions also came on this saying that, what about IPOs? In fact, you can look at IPOs, you can look at even pre-IPOs. Example is, we invested in a company like Automation Anywhere, for a couple of our clients who were looking for global investments. Similarly, you have stocks like Grab, you have SpaceX, okay. In fact, some of these options actually have all been available, and we've sort of shown them to investors, but we have preferred funds to unlisted stocks, out there. Some of the unlisted stocks definitely have done reasonably well, and so they have given good returns, but one needs to understand the risk return linked to it. Okay, the other is you may choose, again, in stocks, you may choose listed stocks, you may choose some of the big names, Tesla, Amazon, etc. And you can see here that they've done extremely well. Like Tesla, especially, 80% compounded returns for 5 years is staggering. Right? So if anybody got it right, okay, and invested in Tesla, they would have made potloads of money. The last is about fixed income. On fixed income, I think India is reasonably good. So when you compare it relatively to India, the only point you need to look at is, say, the currency risk. Okay, so for, let's say, somebody who's an NRI, for example, coming and investing here, of course, now interest rates have fallen, and so if you got, let's say, a 5.5%, and let's say you saw currency depreciation of, say, 5%, then you probably just made 0.5%. Okay, so but even then, I think that it should do a little better than the global stuff. Yeah, so you need to keep in mind the taxation in India, because some of the options, if say they're interest bearing, etc., and they are 30%. So after a 5.5, if you lose 30% type of and times, including surcharge, it goes higher than 30%. So you, if you lose that much in tax, then it may not do as well for you. But in the long term, I think India is a reasonably good market to invest in fixed income as well. So I would not look at global investing in fixed income, maybe other than for a particular need. And when we do that, what have we chosen? We've chosen funds like, which are arbitrage funds, okay, and which take no equity risk, and there are some funds which have a very good track record. Okay, so you can see that the 5 years, almost like 8.3% dollar-denominated return is actually fantastic, and probably crossing Indian returns as well. Okay, but one sort of uses this to balance and for liquidity, but compared to some of the others, if you look at some of the equivalent floating rate funds globally, the last 1 year you've got only 0.06%, and that too in a period when interest rates have sort of gone up a little bit. Okay, so or quite a bit actually globally, which is why you'll find that Invesco fixed income has seen a bit of a negative return in the last 1 year. I'll spend some time on that when I come in there. Just 1 minute. Yeah. The Invesco commodity index is the first one that I'm looking at. And what we'll do, we'll just move a little quickly because and possibly keep more time for discussion and your questions. Okay, but the objective is just to give you a feel of the options, and through examples, live examples, how some of these have done. And like I mentioned earlier itself, I think the 5-year returns 12% commodity is very good. However, keep in mind the 66% maximum drawdown that the index and the fund has also seen. So it can be a volatile one, but where you're looking to take limited risk and sort of taking informed bets. Okay, then maybe at those points of time you can look at commodity index, but I think one is just cautioning you that it can be volatile. Yeah, the other is a gold miners ETF. Of course, the gold miners ETF you also have in India. Okay, and so almost like it's been a good return because gold funds have done well. Okay, but like I mentioned, there have been periods when sort of the funds have really fallen badly. And why does it happen versus gold? It is because here you're investing in gold mining companies. The companies that itself, own these gold mines, right? And there have been periods when governments came back and fiddled around with some of the taxation structures and stuff like that. They put in certain duties on some of these gold mining companies, and sort of which suddenly had a negative impact apart from the price fall that gold experienced. So keep in mind that when you invest in gold mining companies, it also discounts the future growth. So which is why it will be a higher return as well. So a higher risk, higher return. Okay, but it's a a high risk option. So only when you are confident that you think gold will do well, I mean, those are periods of time that you can look at it. However, keep in mind that gold, the way we look at it, gold gives you portfolio insurance, right? So in periods when markets really fall badly, you may find that gold does very well. However, gold mining companies, since it's they are stocks of these companies, may or may not correlate immediately on those falls, but in the longer term, whenever you see good spike in gold prices, the gold mining companies also do better than just the gold price itself. This is an ETF of and silver ETF. I'm not spending too much time here because in India also we have it, so I may not use global funds to invest in, say, silver ETFs right now. Okay, the other interesting category, which I think is very interesting, is actually the funds, and you have a number of these funds like G2, which has done very low volatility, as well as the drawdown also has been very low. So that is something that we sort of keep in mind. Okay, so if many of these funds, right, you may wonder what is this Cayman registered fund. Okay, there are some of these tax havens like Cayman Islands, which allow companies and funds to set up tax-free, set up tax-free funds out there, which means they don't charge any tax, and that is why they are suitable for funds to set up in this jurisdiction. Okay, so because otherwise, what will happen when you go to another jurisdiction? You could have taxation, etc. But a Cayman Island type of thing, Mauritius has been one of them, but notorious for various other reasons. Okay, including whether some of the KYCs are happening properly and all of that. Okay, so that's something which one keeps in mind. But jurisdictions like Cayman, Bermuda, etc., are relatively globally much more respected jurisdictions. Okay, so you may find many of these funds actually run out of them and go and invest globally, and also investors then come in. These jurisdictions also ensure some bit of safety for investors to make it better and safer for them. And so they try and create their own checks and balances to ensure that, investors also protected while investing in their jurisdictions. Okay, so coming back to the G2 fund, very good 15% per annum over 5 years. Okay, dollar denominated return, which is exceptional. At the same time, what we love it for is actually the low volatility and the low risk. Okay, so I'm just trying to showcase that there are funds which are based globally, which manage risk better. Okay, and at the same time deliver a reasonably good return. So if you are looking at long-term investing, which is on the risk side as well, some of these funds may actually give stability yet a decent return to your portfolio. The other one is Fenghe, and this is investing more in Asia. So if you see, the index is what we call as the Morgan Stanley has an MSCI index. And also the it's called Asia X Japan, right? So excluding Japan is what this particular index looks at investing. So you'll find it investing mainly in China, in Southeast Asia, and some bit in technology companies. Okay, but again, this fund also takes short positions, which means it hedges its portfolio as well as goes short. When you go short, in case markets are falling, you can actually make money whenever the markets give negative returns. That is why in a period, and this shows also that how good the risk management of this fund is, because if one goes and looks at the Chinese index, right, you'll see that it's really fallen very sharply. And some of these, and that too, technology companies from the region have fallen very sharply. But even in that period, the fund has been able to deliver a reasonable or 3.5% return, a positive return in this period, shows it's done reasonably well. Of course, what gives comfort is, of this $1.1 billion fund, 10% is owned by its partners. Okay, so the partners itself have sort of invested into the fund. You have ARK was a very famous fund on the, and investing in disruption themes, did extremely well. Okay, of course, it has fallen sort of 25% 1 year return, which is why the sort of even the 5 year returns have come down to 21%. Otherwise, this is a fund which was delivering almost like 30 to 35% compounded returns, for a longer period of time. Okay, since the technology theme has sort of taken a bit of a beating in recent times. Okay, so it has sort of come off, but I'm just again showcasing it to you. I'm not necessarily suggesting it as an investment right now, because I would rather stay out of technology companies, because they've already run up quite a bit, and I just want to watch out for a cycle turning on technology. So that's something where one wants to be a little cautious. That's why I'm not suggesting that we invest. I'm just providing options so that one has a better understanding here. But what's interesting about this fund is, the maximum drawdown is something like 23%. Okay, 1 year return is minus 25. Why is that? So the fund would have fallen, gone up, and fallen again. So the maximum drawdown is a drawdown from the peak, like I mentioned to you, right? So it must have moved in 2 cycles, and the previous cycle also it would have lost some money. But so it's definitely lesser fall than the broader equity markets, if you look at it, in terms of the maximum drawdown from other stocks and equity markets. Now, when we go to some of the income-oriented themes, which are more debt-oriented now, Alliance Income Fund sort of looks at investing in, a combination of high yield bonds, convertible bonds, and also 1/3 into US equities. Okay, so from that standpoint, you may, and while investing in US equities, some of these funds typically what they do, they look at high dividend yield paying securities, so because it's meant to be an income generating fund, right? So in a period where interest rates go up, okay, because they look at high yield bonds, etc. When interest rates go up, you'll find that the funds perform worse, and because of the interest rate risk. And just to give you an example, maybe, so if let's say let's look at now, right? So in India, say interest rates say have let's assume a 6%, okay, for a bond of a certain credit rating, okay, and if the interest rate goes up to 7%, right, and it is a 5-year bond, next say 1 year it goes up 1% from 6 to 7%. A new investor at that point of time will want to have 6% instead of, or rather 7% instead of 6%, right? So his expectation is higher. So if you want to sell the bond to somebody and you have to value it at the market price, right, you will find that the bond has lost some bit of, it has seen a capital depreciation, which means 100 rupees bond today, it has to compensate a new buyer for 4 years with 1% lesser interest. So if I just put a simple calculation, normally there's a financial computation to it. So typically a 1% increase, right, would mean that there's a 1% less that you will get for every year, and so there's so the new buyer will want that 1% from the earlier buyer, and he will look for it at a lower price and 1% per year over 4 years at a simple, without financial computation, which means you may have lost capital of about 4%. Okay, so whenever you have longer term bonds, okay, and interest rates go up, and this is something that we can also keep in mind for while we're investing in bonds or income funds in India. As interest rates go up, you will find that they will not perform well, even if they have securities of a reasonable yield. Okay. The other is about if we look at some of the venture capital funds, and now maybe in India you have a few smaller ones, but funds like Carlyle are among the largest global and respected funds globally on the venture capital side. Okay, and some of these have delivered very, very strong returns. Okay, so you can see some of them almost like 30-40% IRRs, etc. I've seen in some of their funds out there. So there are funds like these which are sort of available. Of course, these may be longer term funds, but one is looking at using some of the best and the largest venture capital funds sort of globally, and that is something which one can also go and invest into globally. Of course, these may not be available to all retail investors, so some platforms may allow you to, they may accumulate it and aggregate it and sort of give you an option to invest at smaller monies, say $100,000 or so. You may be able to invest in a Carlyle fund. In fact, this is something that we also showcase to some of our investors. Vanguard Healthcare is the ETF I spoke of on the healthcare side. It's been a stable, good performer. US markets have done well after COVID, etc. Also, healthcare stocks also picked up and did some bit. Okay, so you find that the fund has done reasonably well. Okay, S&P 500 is the US index. Okay, the broader index which has non-technology as well. Nasdaq is a technology index. Okay, so it has 26% in technology, and you can say healthcare and financials are at 14% and consumers at 13%. So that's a pretty diversified index that one can look at. Volatility is higher than some of the funds, and the drawdown also is, but it's a relatively more stable index than the Nasdaq. But Nasdaq also has in the recent past delivered some very strong returns. Right? The Vietnam ETF is something that I spoke of Vietnam already, so I'm not going to spend too much of time out there. Okay, so that, yeah. So the other is sort of automation anywhere. These are I spoke of. unlisted entities, which, RPA, IPO, etc., which one has sort of looked at and done. So these are options which, we have come back with and, presented to investors in the recent past. So Tesla is we all know that they almost created a revolution in the electric vehicle space, right? And 80% 5-year compounded returns. Okay, but keep in mind that the stock has also fallen, sharply in the past as well. Okay, Amazon is the other one. Again, Amazon is, I think, one of the companies. I think there's some 4 companies or so with over $1 trillion, and so this is one of them, bigger than number of economies globally. Okay, and of course 5-year returns are good, but we are seeing that slowly it's becoming larger and larger, so we need to see how much it's able to keep up with the growth of the past. Okay, Invesco is the other fixed income one. Okay, that you have. This is pure fixed income. I did explain to about bonds already, so that's why this is showing a minus 3.71%. Okay, even though it's mainly investing only in fixed income, which means debt side. So some of the longer duration bonds have actually come down, like I mentioned to you, because globally interest rates have gone up very, very sharply. Okay, and which is also what created a bit of a market scare, in terms of the US markets as well. Floating rate funds which benefit from increasing interest rates have been almost zero returns only, and this particular fund has delivered a 3-year return of 1.13. Okay, now keep in mind that where you take low risk, okay, in the US the returns are very, very poor, right? So and at times 1% also is reasonable for a low level of risk. Okay. I spoke of arbitrage, and this is something that I think is worth considering, for somebody investing globally and wanting to, balance with lower risk, keeping money for, say, children's education, etc. Okay, so something like this is meant to take no equity risk. Okay, is only looking at taking arbitrage opportunities, which means that, and I'll just give you an example. In India, I may buy Reliance limited on the cash market, which is the normally, when you buy a stock, I buy the stock and I may sell it in the futures market. So I just keep the premium that is there. So whether Reliance goes up or goes down, the only thing I will make is the premium that I got from between the future and the spot price. Okay, so those are so this whole fund looks at investing only in arbitrage opportunities. Okay, in summary, so I just wanted to capture and give time for Q&A. Okay, so if you look at what is it that, sorry, this I think. Yeah, so sometimes when you cut and paste, okay, something gets left over. Okay, so basically, if you look at what is it when you should consider when you're looking at global investing, yes, we spoke of all the options that are available. It's important to look at them and understand them. Okay, then the second is how much to invest, right? And we saw that most had nothing. I think that's not the right place to be either. So I would think that for somebody who's starting out, I think 0 to 10% is a good place to be. Okay, but over a period of time, I think one could look at up to 15% if you are reasonably India-based. Okay, and if you don't have maybe requirements that are likely to come up, which are require global capital for you. So I think that could be a bit of what to look at. And you also have, like I mentioned earlier, you have mutual fund options as well as some of these other options. Okay, so and what is the procedure for some of these, especially if somebody is in India? For others globally as well, it may be easier, but in India, what are the regulations around it. Here you will actually transfer money overseas. Okay, and the procedure that RBI has set down. Okay, there's an E2 form that needs to be submitted along with, while you are doing a overseas fund transfer. You very much can invest in and transfer money overseas for investments. The limit per person per year is $250,000. Okay, it's reasonably good, except where we have clients sometimes who sold a company and the money is really large, then you have to maybe try and if you want to have a certain percentage overseas, then that may be more difficult. But for most HNIs, high net worth individuals, okay, I think the limit is reasonably good, especially because it's per person and per year as well. Okay, so that's something that one can look at. And yes, procedurally it is slightly more difficult, but the good part is it's much better than earlier. Earlier, you had to seek RBI approval. Right now, it's more a disclosure, and you submit the E2 form. It's completely administered by the bank, when you're transferring money out. So it may just become seamless. It may just be like one additional form to fill out and submit to your bank while transferring money overseas. Okay, and can we not use Indian mutual funds while investing globally? Okay, so basically, so recently there was an issue that we had that RBI had set a certain limit on a global basis of how much can be invested in. Indian mutual funds can invest globally. We hit that ceiling. All of us expected that RBI would increase the ceiling, but it did not get increased. Okay, so that was unfortunate. So many of the funds, including SIPs that are happening in those funds, have got rejected. The SIPs have not been happening. So some of us who have SIPs running in the global funds, maybe we can wait it out for some more time. Okay, and that was one of the query that came up, right? So what can we do? We can wait it out for some more time, see whether RBI, does make a change, because some bit of representation is happening to increase the limit. And I would have thought RBI would have increased the limit, and so one is not sure why, they are not doing so. But and they may have good reasons for it. But I'm just saying that maybe we'll wait from our side, just check for a few months. But some of these investments which are getting rejected right now, okay, so what we can do is that money maybe push it into some other investment avenue in the short term, and possibly over the next 3 to 6 months we'll have clarity and decide whether to stop them or continue them. And the last is about taxation and reporting. Taxation. Even if you invest in equity globally outside India, whenever it's not subject to security transaction tax, okay, it is treated as non-equity. Okay, so the taxation treatment will be like of debt. So if you ask me, that is a bit of the negative thing that we have on taxation. However, if you are looking at and not only that, because non-equity, the holding period also for it to become long-term is 3 years. Okay, so that's the negative of global investing. Okay, but if you look at a 3-year plus time frame, then I think it will almost equalize, and maybe it will be just marginally costlier, because then it becomes long-term capital gains. Okay, after 3 years, and if you have long-term capital gains, then I'm assuming that these are options which are capital gain oriented, not interest bearing. If it's interest bearing, it's anyway added to income because it doesn't come under the head capital gains. But if it is capital gains and it is more than 3 years, it becomes long term. Okay, then the tax rate is 20% after indexation for inflation. Okay, so and because of the indexation for inflation, you'll probably find that your effective tax rate can, depending on how much the inflation is and what the returns are, your effective tax rate can anyway be between 8 to 15-16%. Okay, so that's what one would sort of expect out there, because what it will do, for example, and how that will be computed, just to give a simplified way of explaining it. if your returns are say 15% and your, let's say, inflation is say 5%, then you will pay 20% tax, okay, on the 10%, which is the incremental return above your inflation, right? In a simplified way, you have a cost inflation index, etc., that, you know, and there's a procedure to compute it, but in a simplified way, this is what it will end up being, okay? And so when you do that, on a 10%, you pay 20% tax. It's effectively 2% on your return of 15%, right? So 2% on 15 will be a little over 10% or so. So that is something which makes it almost, so it will be probably some 12% while in Indian tax we would pay a 10% tax. So and that 12% can go up to maybe 15%, but it'll be somewhere 5% plus or minus if you held it for long term. But keep in mind, long term in India, right? If our Indian equities is something like 10%, and the period also is 1 year, right? So that's the other unfavorable one. The period is 3 years versus 1 year for Indian equities, right? So that is broadly, what I had from my side. Okay. So I now, keep the floor open to questions. I'll also, maybe we'll capture some of the earlier ones that sort of came in as well. Okay. So I think one, aspect that has come up in some of those questions, which is sort of not linked to this particular topic today, is everybody is interested in Indian markets, right? So not only that, the Russian-Ukraine war and what its impact is on Indian equities, because for many of us, that's a larger part. So I will, before I get to the next questions, I'll maybe answer that for you and give what our perspective is. Okay. See, we have always been suggesting that we think India will be the country of this decade. Okay. And the country of the decade, the previous decade was the US, right? And for various reasons, including, interest rates coming down so sharply. Okay. And, you also find that there are a lot of, reforms that have happened, including GST and, all of them. We think that they have all long-term impacts, which are sort of come into play. There are benefits which are coming out of, say, manufacturing. Okay, because so if you go back and see, there has been some bit of disruption that various MNCs have seen with respect to China. One is because of they had a trade war with the US during Donald Trump's time. Okay, and also due to COVID, there was again sudden disruption that happened. So most MNCs are saying that, what we want to look at, China plus one as a strategy for fulfilling their requirements, of purchases and, manufacturing and subcontracting and outsourcing, right? So from that side, again, you have certain benefits which are coming there. So India is definitely a beneficiary of it. India has also the Modi campaign of Make in India, I think, came in very timely because it started early, and when the inflection point came, there was sufficient branding about it, around it, as well as the certain benefits that exporters got, right, which sort of came in well at this period of time. So you have the PLI scheme, the performance-linked incentives, okay, for exporters, etc., which sort of and manufacturers especially, which has come in, and that is also sort of likely to benefit. There is some bit of movement on certain areas like specialty chemicals and pharma, etc., where India is becoming a bigger and bigger dominant provider for the whole at a global scale, right? So that those are sectors which are sort of developing and emerging and becoming larger and larger. Okay, so and that's likely to expand into various other segments. There's a lot of innovation happening. In fact, that's the other one which we think will deliver, additional GDP growth to India. The whole digitization that has happened, as well as a lot of the startups and the whole ecosystem that has come alive, and what the spin-offs of some of this innovation and entrepreneurship in India is also, I think, likely to do well. So India, I think, will continue to do well, and we expect things to happen well. Now, coming back to because most people have a slightly negative view of India, and why are we coming back and saying we are still positive right now? Okay, in line with whatever we said, one was expecting that earnings growth will come back to India, right? So, which means that the profit growth at a whole index level, all the companies in the index, how has it grown, right? So that has been reasonably strong, and this is very evident from the all of us look at certain valuations ratios, and the P is a valuation ratio, the price earnings ratio, right? What is interesting is over the last 1 year and last 1 to 1.5 years, the P ratio, which was something like 35. Okay, of course, it had gone to almost like 45, etc. At the time of COVID, but then it stabilized at 35 and stuff. But in this period, while markets went up, right, you found the P ratio falling very sharply from 35. It hit a low of 20 odd, at the time of the Ukraine war. So now it has come back to almost like 22, 23. It's been hovering around that range. Okay, and now this is something which we think will drive the next growth, because if it's earnings based, it means fundamentally companies, the stocks will go up if earnings are growing. That's broadly, in the long term, it's reasonably well correlated, even if you look at data, right? So and typically people say when it's coming closer to 20, and 20 and below is a very good buy. Okay, but even closer to 20 is reasonably good. In the long term, if you look at the CRP ratio has been anywhere between 24 to 28, and it used to be hovering in that. So right now we are below that range, which shows that valuation wise, India is not a bad place to invest. Okay, and when it goes above 30, for example, and 28, 30, it's a warning signal that market valuations are high. And we saw this, a couple of years back and stuff. So valuations were high, but now because of earnings growth, we think valuations also are reasonably attractive, and which is why I think that we are also bullish in the short term. However, the various global events could create short-term volatility. In fact, that's been our view as well, that we can see volatility, but we have a positive bias even in the short term. In the long term, of course, we are very, very positive. So I think so that's my little bit of a view on Indian markets as well. Okay, so maybe now we can start taking the questions. So one question was from Pradeep was, with rupee depreciation so much, is it worth investing in global stocks? Yes, we think that rupee has depreciated, and from here we'll probably see rupee appreciation. But I think still from a diversification standpoint, I would still go back and diversify out there. Investing in US stocks, like one mentioned, I have been a little negative about US per se. I would rather look at something which is more diversified, and even if one invests in US, I'll probably look at the S&P 500 indices, which are slightly broader based, rather than let's say technology indices. And why is one negative on the US? Okay, part of it is I study market cycles, and it's an interesting correlation that if you look at whichever is the country of whichever country leads in a particular decade and does very, very well, right? That country does poorly in the next 2 decades. Okay, because excesses happen, in good times. And so in the US, for example, there's the borrowing of the company is very high. They're taking a lot more risk, etc. So one is a little, not so positive about, US markets. And we think that will sort of move over. The other reason, apart from just, markets, I mean, so timing wise, is also we think what will cause that, I think higher interest rates, because one believes that in this decade, interest rates are going to be higher thanks to higher commodity prices. Okay, so that is something which we will sort of continue to see out there. Okay, so I spoke of already of international mutual funds and stuff like that. Okay, we can help you with platforms if you want to look at investing. Perspective on Bitcoins and NFTs. Okay, unfortunately, I'm not an expert on this, and I think one would like to bring somebody with better expertise who can possibly take a session on Bitcoins, NFTs, and cryptocurrencies. Okay, so that we will arrange for a session. Let's maybe try to do it in the next maybe month or 2 months. Yeah. So US stocks, if somebody still wants to invest, there are platforms which are available, and that's the simplest way to do, to sign up to a platform. Okay, you can reach out and can suggest a few, platforms out there. Yeah, so big recession seems in market considering global environment. I think sometimes what we see on the ground and what happens in markets is a little different. The interesting part is, and the interesting data, of course, I'm not sure it's something that we should be happy about, but the fact is that, if you see at every large event, including, wars, in fact, we just look at wars in the past, right? It's interesting to see that 8 out of 10 times markets actually went up within 6 months to 12 months. Okay, so from that standpoint, I still think that, because personally, I like to take decisions which are driven by data rather than getting emotional and looking at what's happening around at this point of time. That has helped us take contrarian calls, which have also done well for clients. Okay, which is why during COVID time we went and said buy, right, while there was complete uncertainty around, right? But one saw data, one looked at trends, one looked at some of the past trends of the past, such viral infections, etc., and what happened, and markets, and one felt that we would find it, things improve quickly. I already spoke of how much as well. Yeah. So why Vietnam? Okay. Yeah, Vietnam is also likely to benefit from India plus one type of environment. Okay, so to that extent, Vietnam is definitely likely to do well. But like India, so see, if you look at India from the eyes of foreign investor, they see India as very high risk, and it's actually true, because if you see the larger, you see good market rises, the market falls also large. Right. So from that standpoint, in India, say a 15% market fall and 15% market rise is nothing. Okay. We've seen a number of cases where, markets have fallen more than 40% and in that range of 40 to 65%. Right. So, which basically means if you invested 100 rupees, it's either gone to 60 rupees, 40 to 60 rupees or so. Right. So that's the type of fall that we have seen in the past. So similarly, Vietnam also will be a country, emerging market like that. They would, if there's flight of capital from FIIs, okay, at least today, India, when it's seeing a flight of capital, it has a very strong domestic investment cycle happening, which is sort of compensating for it. So that is something which is there. Okay, Srinivas interested in investing directly in Russian equity markets. Okay, I don't think Indian companies will have options to invest directly in Russian markets, but I think some of these platforms, maybe one can look at Russian ETF. Okay, I've personally not looked at it. I didn't have that high risk profile. Okay, and I didn't think Russia was going to do well, so I didn't look at it. But maybe one can look at it and see. I'm sure that there should be some Russian ETFs around. Okay. Other than the US, which countries? Yes, we spoke of this. In fact, the second question that was part of it is, are there investment opportunities in Middle East and Qatar or UAE? Some of the stock markets in these regions are not, very well developed compared to like even India and some of the other regions. So part of it is, I think, a lot of maybe the way the businesses have evolved in these regions is a little different from, let's say, the open market. It's not completely open market like the others, right? So it's a relatively controlled environment that you have, in some of the Middle East countries. So today, I am also not aware of too many funds that even invest into some of these companies out there. But what one can look at is to say, I would rather, because where the market is not developed, I would rather not touch that particular market. Okay, what I would like to see is, what am I investing in that country for? Right? Okay, for example, if I think it will benefit from oil, right? So then I go back and look at which are the other countries which are there, which we can benefit from oil. Or if I want to say, okay, is maybe which are the countries benefiting from commodities. So or whatever the reason that one is looking at, maybe look at the underlying and find either companies or countries, which sort of do a better job of that. I may go and invest in stocks of, some of the large petro companies and stuff like that. Okay, but from here, I must just say that price is already very high, so I would be a little cautious of investing in oil stocks at least. But yes, countries that benefit from high oil prices, definitely, I don't think prices will come down and go down really sharply in overnight, right? So one could look at it. One question that came out: which sector would be the most would benefit most from India for the China plus one type of situation? See, China plus one, there could be various sectors that benefit. Okay, one could be, let's say, even the electronics, for example. Today you have companies which actually do outsourcing of electronic goods. So in fact, we ourselves have invested in, let's say, Dixon Electronics, and I must say that one holds a stock, so that's a disclosure that I want to give, being the CIO. Okay, so and this is also not a suggestion to buy or sell, but any stock. Okay, but see, companies like them actually, they outsource, say, mobile phones and washing machines and laptops, etc. And they have large MNCs that they do it for, like Samsung. Okay, so today they benefit from. We think that some of the specialty chemicals is another place that we have seen which sort of benefit from the China plus one. And there could be a lot of, say, core manufacturing facilities. It may be, automobile ancillary, may have various others, okay, which, one can sort of look at it. So I think we are over time. Okay, so I would like to stop here and thank everybody for joining. Okay, happy to, for some of you, if you want to also come and unmute and also talk from here. Okay, but so just wanted to let go, others if they want to leave. Yeah, thank you for joining this session.
Thank you, everyone. Thank you for joining in. We will be sending recording and this PPT along with the feedback form. Please fill that, and if you want us to cover any specific topic, please mention there. And thank you, everyone. Thank you for joining.